Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Yeah, and there is definitely a lot happening right now to break down.
Right. So, I want you to imagine looking at a snapshot of the broad American economy. You probably assume you're seeing this perfectly balanced picture, of all these different industries working together.
That's the traditional view, yeah.
Exactly. But then you realize that a full one-third of that entire picture is completely dominated by just like a handful of computer chips, servers, and tech giants.
Right, which is, I mean, it's pretty staggering when you really think about it.
It is. And that is the reality of the S&P 500 today. We're doing a deep dive into some recent analysis on this because the index we were all taught to view as the ultimate diversified safety net, it's completely lost its traditional identity.
Yeah, it really has.
Based on the data, it's basically morphed into a vehicle that is heavily reliant on massive artificial intelligence investments and, well, just sheer momentum.
And, the stakes for understanding this transformation couldn't be higher for your portfolio right now. Especially since here we are in March 2026, and we are witnessing this real-time collision.
A collision between the tech boom and the real world, right?
Exactly. On one side, you have this new, highly concentrated, AI-heavy stock market. But on the other side, the real world is aggressively pushing back. I mean, we are looking at a sudden outbreak of geopolitical conflict, oil prices surging past $100 a barrel, and inflation that just refuses to cool down.
Yeah, it's like we're living in a world where the market's fundamental structure changed right as the global economy started throwing massive curveballs.
Precisely.
So to put this whole identity crisis in perspective, let's look at the raw numbers. According to the recent analysis we're diving into, growth stocks now make up roughly 46% of the S&P 500 index.
Which is huge. And meanwhile, value stocks have shrunk down to just 11%.
Wow, just 11%. And for anyone new to those terms, let's keep it really simple. A growth stock is basically a company valued on the promise of massive future profits, usually tech.
Right.
While a value stock is a company priced based on the solid, reliable cash it's generating right now, like a bank or a traditional manufacturer.
Exactly. And technology alone now represents about 1/3 of the entire 500 company index.
That's just crazy.
It is. And that incredible concentration really sets up the core challenge we are tackling today.
Yeah.
Because if the market is no longer the diversified safety net it used to be, well, how do you protect your money?
Right.
How do you actually find growth without taking on these hidden massive risks when the macroeconomic environment gets really hostile?
So to figure that out, we have to understand the mechanics of how we got here. And I like to think of the S&P 500 like a basketball team.
Well, I think
Yeah, so historically, you wanted a team where the scoring was distributed evenly across the roster. You had your centers, your point guards, your forwards.
right. And those represent the different sectors of the economy.
Exactly. Industrials, financials, healthcare, retail, everyone played their part. So if the retail sector had a bad quarter, healthcare or industrials would step up and carry the weight.
But today, that's not what's happening.
No, not at all. Today, we're watching a team where one absolute superstar player is taking like 90% of the shots and scoring almost all the points.
And the projected earnings data completely backs up that superstar analogy. When we look at 2026, tech earnings are expected to grow by over 30%.
Over 30%.
Yeah. Compare that to the S&P 500 overall, which is projected to see a 15.5% increase. But even that 15.5% average is heavily distorted.
Distorted how?
Well, the Magnificent Seven, the absolute giants of the tech world, they're forecasted to jump by 23.5%.
Wait, which means the other 493 companies in the index are basically just being dragged upward by the superstar?
Exactly. If you take the tech giants out, the rest of the American economy is looking at a much more modest 13% growth projection.
Okay, but let me push back on that for a second, because I'm looking at these 30% growth projections, but I also see the news. I mean, every other week, a major tech company is announcing massive layoffs.
Yeah, that's true.
We're seeing thousands of tech workers losing their jobs. So wait, is everything with a tech label just printing money right now? How can the sector be carrying the American economy if they're actively firing people left and right?
That's a great point. And that disconnect between the headlines and the earnings is driven by a literal civil war happening inside the tech sector
A
itself.
civil war.
Yeah, because when we say tech is booming, we are talking about a very specific reality. Anything related to the physical reality of AI, so semiconductors, microchips, and those incredibly power-hungry data centers, that stuff is seeing astronomical growth.
Okay, so the infrastructure side.
Right, that's the infrastructure side.
But the software side is a completely different story, isn't it?
Oh, completely different. Traditional software is struggling heavily. Based on market analysis from late February, software stocks had actually dropped about 23% year to date.
Oh, wow. Down 23%.
Yeah, and that drop happened even as the overall tech sector's earnings outlook went up.
That's wild.
So the growth narrative is hyper-concentrated strictly on the physical building blocks of AI. Many of the older software companies we traditionally associate with Silicon Valley, they're the ones undergoing heavy restructuring and layoffs.
Right, because they are scrambling to pivot their business models to AI. So the takeaway here is that the hardware side is growing so massively that it mathematically covers up the 23% losses on the software side.
Precisely. That means when you hear tech is booming,
Yeah.
you have to know exactly which part of tech you're buying into.
Okay, so that heavy reliance on AI infrastructure brings us to a huge vulnerability. Because, going back to my basketball analogy, we have this superstar player carrying the team. But what happens when the stadium lights flicker?
And that's exactly what the recent March 2026 shocks did.
Yeah, the geopolitical war breaking out, oil over $100, a strong U.S. dollar. It served as a massive reality check.
It really did.
Yeah.
And the data details the exact catalyst here. Perhaps the most important factor for the markets was the sudden realization that the Federal Reserve wasn't going to cut interest rates anytime soon.
Right.
By mid-March, the 10-year Treasury yield had climbed back up to around 4.23%.
Okay, let's break down the mechanics here, because for a beginner investor, on the surface, this can feel really disconnected.
Sure.
I get why oil hitting $100 a barrel is terrible for a shipping company or an airline or, just for you and me paying at the gas pump. But why does a semiconductor manufacturer or an AI cloud data center care if oil hits $100?
Well,
I mean, they run on electricity, not gasoline, right?
right, but it's all about the domino effect.
Yeah.
The first domino is the direct hit to the consumer. A 30% spike in oil prices acts exactly like a tax.
Ah, okay.
When people spend more on gas, they spend less on everything else. And that consumer pullback alone can cut overall S&P 500 earnings per share by up to 4%.
Wow, just from people not buying extra stuff.
Exactly. But the much bigger domino is inflation. Sustained high oil prices guarantee that inflation stays hot across the entire supply chain.
And if inflation stays hot, the Federal Reserve is paralyzed. They can't lower interest rates to stimulate the economy.
Exactly.
Which brings us to why high interest rates are basically absolute kryptonite to these massive tech growth stocks.
Right, because to understand the math, you have to look at how these companies are valued. A growth stock's current price is based on the promise of massive profits 5 or 10 years down the road.
Okay.
But when you are analyzing a stock, you have to discount those future profits back to today's dollars. If the risk-free rate, like a 10-year U.S. Treasury bond, is paying you a guaranteed 4.23% right now, the value of a promised dollar 10 years from now just plummets.
Right, because why would I take on the huge risk of buying an AI stock for a potential payoff in 2035 if I can just sit in a completely safe government bond and make over 4% every single year?
Exactly. The higher the interest rate goes, the less those future tech profits are worth today. And not to mention, these tech companies are borrowing billions of dollars to build their data centers.
So when rates go up, their debt gets vastly more expensive.
You hit the nail on the head. And we really have to place this in the current political and global context, too.
Right, because with President Trump currently in office, we are seeing strong pro-business domestic policies. A lot of deregulation efforts.
Yeah, but here's the thing. Even the most aggressive pro-business administration cannot instantly shield the domestic stock market from a sudden global supply shock.
Right, like a geopolitical conflict that drives global energy prices through the roof.
Exactly. The macro environment always finds a way to assert itself.
The market woke up and realized the real world still dictates the terms, and the data shows it. By March 17th, the S&P 500 was down roughly 3% from its pre-war levels and down 2% for the year.
It's almost as if investors had convinced themselves that traditional economic cycles were just dead.
Like AI was this magical force that could just outrun inflation and interest rates forever.
Yeah, but the traditional macro cycle never left. It was just temporarily overshadowed by the sheer momentum of the AI boom.
Which brings us to the actual price tag of these companies. Because if these companies are suddenly facing massive borrowing costs and their future earnings are being heavily discounted, that has to be eating into their actual value.
Oh, absolutely.
Are we vastly overpaying for this AI revolution?
Well, analysts refer to this as the price to perfection problem. Before the March shock hit, the S&P 500's forward price to earnings ratio, which we call the PE ratio, was sitting at a hefty 21.6 times.
Okay, let's clarify that for a second. The PE ratio measures how much investors are willing to pay today for $1 of the company's future earnings, right?
Exactly.
So paying nearly 22 times a company's future earnings is historically very high. It implies that investors expect absolutely flawless, uninterrupted growth.
Right. And when you look globally, the U.S. market is incredibly expensive compared to the rest of the world. Based on recent analysis, while the U.S. was trading around that 21x multiple, Europe was sitting at a much more reasonable 15x multiple.
Oh, wow.
Japan was at 17x, and China was down at 13.5x. The U.S. market has essentially priced in an absolute best-case scenario for the future of AI.
Well, the rest of the world is trading on like normal, traditional fundamentals.
Right.
It feels a lot like buying a luxury electric car.
Yeah, what do you mean?
Well, imagine you buy this top-of-the-line luxury EV. It's an amazing vehicle. It's the future, right? But what if the electricity bill to actually charge it at your house suddenly skyrockets?
Oh, I see.
Yeah, your entire return on investment gets wiped out because the daily cost to run the thing is just too high.
That is a perfect analogy.
Mhm.
Because the electricity bill for these tech giants is staggering right now. We call it CapEx, or capital expenditure. And recent estimates show that by 2026, the CapEx for the hyperscalers, meaning the money tech giants are spending just to build out their AI capabilities, could reach a staggering $770 billion.
Wait, $770 billion just to build the infrastructure.
Just to build it. And with the cost of power surging and the cost of operating these massive facilities rising, investors are finally starting to do the hard math.
They're questioning the actual return on investment of AI. Like if it costs nearly $1 trillion to build, how long will it take to actually make that money back in pure profit?
Exactly. And this is why valuations are so incredibly sensitive to interest rates right now.
So if it takes longer to become profitable, or if high oil prices keep inflation running hot, do these stocks just crash? Does the luxury EV just break down?
Well, it's less about a crash and more about a rapid repricing. Goldman Sachs outlined some very clear scenarios on this based on the data.
Okay, what are they looking at?
Their base case is that the AI story isn't dead. They maintain a year-end target of 7,600 for the S&P 500, assuming inflation stabilizes.
Okay, so there is still hope.
Yes. But they warn that if a severe oil shock persists and inflation stays hot, the S&P 500 could drop down to 5,400.
Whoa. From 7,600 down to 5,400, that is a severe haircut for anyone holding a standard index fund.
It is, but the mechanism behind the drop is what's important. A drop to 5,400 would bring the U.S. market's valuation down to a 16x multiple.
Ah, okay.
It wouldn't mean that artificial intelligence failed or was a fraud. It would just mean the market decided it was only willing to pay a normal historical price for the future.
Rather than paying for that perfect scenario premium. So, okay, let's pivot and break down how an everyday investor can actually use this data.
Let's do it.
Because right now the market is top-heavy, AI is an incredibly expensive but fundamentally necessary technology, and inflation is actively threatening things. What exactly is a regular investor supposed to do with all this information? Do you just sell your tech stocks and hide in cash?
No, selling all your tech exposure would be a significant mistake. The data on investor behavior is very clear here.
Really? Even with the shocks?
Yeah. Whenever the market gets jittery and drops, like it did around March 16th, money almost immediately flows right back into the AI leaders like Meta, NVIDIA, and Micron.
Interesting.
When the panic subsides, institutions know that AI is still the primary engine of the market. You don't want to throw the engine out of the car just because the road got bumpy.
Okay, I like that. But if AI is the engine, what's the airbag? How do you protect your investments?
Market strategists call the airbag strategy broadening. According to recent analysis, 2026 is the year where you must deliberately balance your high-flying growth stocks with grounded value stocks.
So keep your core tech, but build a defensive wall around them.
Exactly, using sectors that actually benefit from inflation or traditional economic cycles like financials and industrials.
And I want to look closely at a piece of data that proves this broadening concept actually works, because we hear constantly about the regular S&P 500, which is market cap weighted, right?
Right, which means massive companies have a massive impact on the score.
Exactly. But if you look at the equal weight S&P 500, the story changes completely.
The equal weight index is such a vital tool. In that index, the absolute smallest company has the exact same voting power and impact as the largest trillion-dollar tech giant, like a true democracy for stocks. And the data shows that the equal weight S&P 500 has actually risen over 5% since late October.
Which proves there are real gains outside of big tech.
Yeah. While the financial news is hyper-focused on the turbulence of tech giants, there's a whole undercurrent of smaller, traditional businesses quietly gaining ground.
To put this into a practical timeline for your portfolio, we can break it into 3 strategic horizons. For the short term, so the next 1 to 3 months, you should expect continued volatility from oil and the Fed.
So hold the AI core, but actively add those defensive buffers like equal weight funds and healthcare.
Right. Then, for the midterm, say 6 to 18 months out, you need to focus heavily on the quality of your AI investments.
Think back to the Civil War in tech we talked about, right?
Exactly. Stick to the companies generating real revenue from the physical reality of AI right now. Power generation, industrial cooling, semiconductors. And strictly avoid the ones just slapping an AI label on their old software to sell hype.
Yes, because they will be the first to fall. And finally, consider global diversification.
Right, because we established the U.S. is trading at a massive premium, nearly 22 times earnings, while the rest of the world is cheaper.
Allocating some funds to non-U.S. markets, like Europe or Japan, provides a really strong counterbalance. You're essentially buying high-quality global companies on sale.
That makes perfect sense. So, to synthesize everything we've uncovered today, we started by looking at an S&P 500 that has fundamentally transformed. It is a tech-driven, AI-heavy index now.
Completely.
And while the AI infrastructure build-out is undeniably the future, the recent macro shocks prove that no stock can outrun the real-world math of oil prices, inflation, and high interest rates.
We are in a new era where cutting-edge technology and traditional macroeconomics are deeply intertwined. You have to respect the math of valuations and deliberately build balance into your portfolio to withstand the shocks.
Which leaves you with a really fascinating thought to ponder as you review your own investments this week. We just talked about how tech giants are projected to spend $770 billion building out this AI infrastructure.
It's a massive number.
And everyone is rushing to find the next genius AI software company. But think about the physical reality of a modern data center. You have thousands of servers running white hot, 20/47, consuming massive amounts of power.
Oh, absolutely.
So perhaps the safest, most overlooked investment in this entire AI gold rush isn't the glamorous software itself.
What do you think it is?
Maybe it's the companies supplying the raw, unglamorous electricity, the heavy-duty copper wiring, and the industrial cooling systems required just to keep those massive machines from melting down.
It's the classic pick-and-shovel strategy updated for the 21st century. While everyone else is panning for gold, you invest in the companies selling the shovels.
Exactly. Something to keep in mind the next time you see a headline about a $1 trillion AI breakthrough. Don't forget to subscribe and hit that like button.